Okay, good morning everyone and welcome to the investment meeting for February 2014. Let's quickly go around the room, introduce ourselves for the record.
Good morning, Rosemary DeBellis for the Police Department.
Doug Maynard for the Police Department.
Barry Dennis, SIS.
Dan Torelli, PBA.
Joe Alejandro, PBA.
Bob Ganley, SBA.
Steve Abilia, LBA.
Demetrius Romeliotis, CEA. Bill McNeely, DEA.
Bob North, Actuary.
David Jennett, Controller's Office.
Martin Gans, Controller's Office.
Seema Hingorani, Controller's Office.
Susanna Vickers, Controller's Office.
Thad McTee, Controller's Office.
Janice Emery, Mayor's Office.
Justin Holt, Department of Finance.
Kevin Holleran, Pension Fund.
Brian Cook, Controller's Office.
Chris Plott, Controller's Office.
Rafiki Castro, Controller's Office.
John Mercer,
Alex Demier, Controller's Office.
Evan Mount.
Nicole Giambrisi, Pension Fund.
Bob Sansky, Stat Pension Fund.
Okay, with that I'll turn it over to the controller.
Okay, thank you. So we thought we'd start with public session on our first agenda item, which is the December monthly performance review. Does everybody have one?
Marty, do you have the next one?
Okay. So these are the December numbers, and we'll go through those shortly, and we'll also, I'll tell you how January was, which was a very challenging month in the markets, especially for the equity markets. So a bit of an overview of what's been happening, and then we can go through some of the numbers specifically. But so in the month of January, we had a number of things going on, as you may have read. Concerns over China slowing, emerging market currencies having steep declines. The Fed has continued to taper their bond purchases, so we've now gone from $85 billion a month to $75 billion a month, now to $65 billion a month. We have a new Fed chair who's taken over, creating some uncertainty about what she's going to do. The debt ceiling debate will happen again in Congress, which is concerning people, and that's supposed to take place in February, so this month. But then on the other hand, I'll point you to a couple economic charts. The economy is actually doing okay. So if you turn to page 5, you can see this is the unemployment rate, and we've actually ticked down quite significantly to 6.7%. And that number keeps trending down. Now there are debates going on, and it's actually true, where the labor participation rate has also gone down. So if there are fewer people out there trying to find a job, that number is just going to keep going down. So that'll be an ongoing debate, and the Fed has been targeting a number of it, 6.5% unemployment. We may start to think about raising rates. Well, they've sort of put that to the side now because the economy, while it's looking better, there's still so much uncertainty out in the markets. If you turn to page 3, just a couple pages back, another indication of stability and slight growth in the economy is the ISM Manufacturing Index, where it stands right now at 57, and really anything above 50 is showing some expansion in the economy. But again, going back to all of this uncertainty that we just talked about, one measure of that is the VIX, and if you turn to page 18, this is the volatility index. And these numbers are not as up to date, but it has spiked a little bit. It's actually spiked a lot more now. We're now more into the 20s, and we're showing here 18. So the index is spiking. There's more uncertainty. People are more nervous, and that's also evidenced in the 10-year Treasury. If you turn to page 20. The Treasury the 10-year had actually gone above 3, and now it's down below. It's down to 2.7, and actually as of today or yesterday it was 2.65.
It was 2.5 actually.
2.5. So again, there's a lot of anxiety out in the marketplace. Some of it is related to certain factors going on in the world, and so some of it is just related to nervousness. But let's go then to December, because December, it's older now, but it was a better month. And so if you turn to page 27, we'll go quickly through here. So in the month of December, the Russell 3000 was up 2.64%. EFA, a few rows down from that, was up 1.5%. Emerging markets, down 1.45%. Core plus 5, down about 58 basis points. High yield, up 55 basis points. TIPS, down 1.47%. Converts, up 1.95%. And REITs, up about 54 basis points. Now the month of January. The Russell 3000 down 3.16%. EFA down 3.99%. Emerging markets taking a much bigger hit, down 6.55%. Core plus 5, on the other hand, now we're going to get strength in fixed income, up 1.88%. High yield, up about 68 basis points. TIPS, up 2.23%. Converts, up 1.89%. And REITs, up 4%. So that gives you some sense of the numbers behind January. And then if you turn to the next page, 28, this is again back to December, and it's where we made our money in December. In the left column here, the 1 month total return for the fund was 1.2%. And if you go over a couple columns, so the fiscal year to date through December 31, the fund was up 10.8%. That's great through December. Then if you take January and what we just went through, we're sort of estimating that we were down about 2%. So that still puts the police pension fund up close to 9% for the fiscal year to date through January, which again is a very good number in spite of what's going on right now in the market. So that's good. And I can just tell you too that the AUM for police at the end of December, 12/31/2013, was $32.1 billion. Factoring January, as of the end of January, the fund's still up over $30 billion, so it was up to $31.7 billion, so just slightly down below the market 12/31. If you then turn to 2 pages over, so page 30. This just goes through how we're set up as of December 31. It's our asset allocation. And here I'll just point out a couple things. So the green bar to the left and then the darker blue bar to the right. So this is our U.S. equity allocation and then our Core plus 5, which is the blue bar. So we just want to note that we are now within the ranges for U.S. equity and Core plus 5. We had sold down some equities for benefits. And the markets, just given what has happened to the markets, we are now back in balance. So we're good there. And if there aren't any questions, I will have us move on to the next item.
Can I, Sina, may I ask a question?
Sure.
We've heard before at previous meetings when we look at this page 31 that while the report that you're providing shows us being out of balance, that you have done some rebalancing and then we're now back in balance. But then it seems like the next time we have a meeting, we're kind of back out in balance. So can you describe to us or remind us what our rebalancing policy is and why is it that when you rebalance us back, we always seem to get back out of it again?
Want to answer?
Sure. So what's happened through the end of December, you've seen reports for September, October, November, December, and we've taken action to bring us back in balance. But as you've seen in the market, while we've taken action to bring ourselves back in balance, the market's been incredibly strong. And so while we are moving a lot of money, we moved some significant money in October and November, the equity markets, as it turns out, were even stronger. In January that just passed, we also moved some money to pay benefits. And in addition, the markets, the equity markets finally didn't go up. Not that we don't want it to go up, but they didn't go up, and in fact, fixed income markets went up. So the combination of paying the benefits and the equity markets and not going up as much as they did in the prior months were sufficient to put us as we are today. We just estimated where we were yesterday in balance. What our target is when we're moving the money, as Barry knows, we move it to the target, or just inside the target, for purposes of rebalancing.
So can you just say that again? So you move it to the target allocation?
Just inside the target.
Just inside the
Just
target.
inside the target.
That's right.
Okay, so you're moving it, so if we're at 28.7% in total fixed income, you're just moving it to 29.2%, instead of back to the policy target, which is 32%.
That's
And
right.
so any little change in the market then flips it out of balance again.
It could, and that's why we moved it back a little bit.
Yeah, any dramatic change. We had dramatic changes late last year.
Yeah, oh, absolutely.
Right.
Right. And I'm just thinking back to the research that I've read on rebalancing, and there has been, perhaps Barry can advise as well, that there is definitely a benefit to having a disciplined rebalancing policy. The research that I've seen seems to either advocate a rebalancing back to target or back to a midpoint that is somewhere between the outer edge and the target. I haven't quite seen a lot of research that advocates rebalancing just to back inside.
Well,
the edge.
when I say just inside, it's really the target, but we're making sure that we're inside the target when we do it, because the equity markets had kept going up. So we were, every time we were planning to move the money, you needed to move more money because the
Yeah.
equity markets kept moving up. So when I say we're moving to just inside the target, that's what I'm referring to.
So it was,
We're really moving towards the target.
right. It's basically what you're describing as the midpoint, but it's not like an actual exact midpoint
Okay.
number.
And the only reason I'm raising this as a concern is that obviously monthly, you don't want to rebalance every month because it creates transaction costs and it's expensive for the fund. And so I'm wondering if, given the volatility and what we might perceive to be the ongoing volatility of the markets, that we might get closer to the target or closer to the midpoint to alleviate some of the transaction costs and cut down this monthly rebalancing that we're doing, or examine some other options.
One of the issues in doing, we could examine the options, but one of the issues in doing that is where does the money go? So if we're going to be selling out of equities, the money's going to presumably go into fixed income, which we're very concerned about, notwithstanding the rally that we've recently had in fixed income. But the rally we've had in fixed income recently is simply stealing returns that are going to come from the future. And so we would have to talk to Barry and think about that internally and come back to you on that.
I think it is worth a discussion, and perhaps if SIS has some research that your firm has put out with regard to rebalancing, that would be instructive for us as trustees to look at. That would be helpful as well.
And we do have, and you're right, the research basically says go, when you fall below the bottom boundary, you go halfway back. That's basically the research. However, we're in different times now. And I think when I last reviewed the capital market expectations, and it was late summer of 2012, right around in there, and this was following a presentation you had from John Bright, the risk guru. He said, don't have any bonds. And I pretty much said, that's not really prudent, but because the equity risk premium is at an all-time high, we should be at the bottom of our fixed income ranges. And that applied to Core Plus 5 and TIPS.
So when your tactics take you to that conclusion because the equity risk premium is high, then rebalancing all the way back to the midpoint doesn't really make sense. And keeping it near the lower boundary makes sense. And I'm sure Martin could demonstrate for you how much value that has added over the last 15 or 18 months, depending on when we moved into that position. It's been huge. Now I'm going to be reviewing capital market expectations later, and the equity risk premium is lower than it was 18 months ago, but it's still way above what normal equity risk premiums are. So following that discussion, we might want to have a discussion on, do we want to stay at the bottom or do we want to start creeping up towards normal? And if we want to go back to normal, then rebalancing back to that midpoint between the target and the lower boundary is perfectly appropriate.
Great. Yeah, I think we should have that discussion. I think it would be instructive to the board. And I think I, too, would have a greater level of confidence with regard to the policy if I had a better understanding of what the House views are of BAM. At the moment, I don't quite have clarity as to how decisions are being made with regard to what your positions are with regard to valuations in capital markets, why you're not rebalancing to the midpoint between the target and the outer limit today. I think just clarity into your House views would give me a lot greater confidence level in the day-to-day operations that are taking place with regard to rebalancing.
Okay, sure. We do plan to come back next month with some more details around some of that thinking, so
that would be terrific.
We can share that then.
Great, thank you.
Any other questions? Okay.
Before we go on, Barry, can you share some of that? I know it's boring material, but a number of studies have been referenced at the table. Maybe you can send the hyperlink or the actual study to the trustees. And that way we can have a more informed discussion about it. Sure. For those who have no life, and whatever, read that when we can.
Yep.
Guilty. Yeah. And maybe Jan, if you want to share the studies that you referenced, also that would be good too.
Yeah, I will actually.
So we're going to move on to the IPS, and it brought this topic up. It was the December board meeting, that we would come back to the board with the details around the language with respect to the REIT-IPS. So I'm going to turn it over to Yvonne.
And good morning, everybody. So in the board books, page 6 is a very brief presentation, and this shouldn't take long. This is a continuation of bringing our IPS document up to date. As you know, there were a number of conforming changes that we talked you through in December, and notice that we didn't capture the decision regarding REITs as a parking place for real assets. And just to kind of walk you through the timeline, our asset allocation was approved in 2011, in which 6% was allocated to real assets. At the moment, that's real estate and infrastructure. Later in the year, in December 21, as we started to talk with SIS about parking places, at that meeting, the unfunded commitments in real assets was recommended to be invested 0 to 50% in equities, which could include REITs, and the other 50% in TIPS. And that recommendation by SIS was approved in December 2011. We moved on to invest some of those unfunded commitments in real assets, about $125 million in mid 2012. in a passive global strategy, which is managed by State Street. The objective there is to achieve in excess of the benchmark, which is the FTSE EPRA Nareit Developed Liquid Real Estate Securities Index. It's real long, and I can't find an acronym anywhere, so sorry about that. So they have to beat the benchmark over a market cycle. Market cycle is considered to be 3 to 5 years. At this particular point, as of November 30th, and as I look at the monthly reports we receive, also as of year-end 2013, the market value of the police position in REITs for its unfunded commitments is about $151 million. So at this particular point with your unfunded commitments, we have 18% in REITs, we have the other 32% in domestic equities, and finally 50% in TIPS as recommended by SIS. So on the last page, you just see some proposed language that we intend to insert into the IPS. It is substantially the same as the REIT language that you would find for REITs in the other systems. And so, I present this to you as a housekeeping item to update our IPS document.
Did I hear that Townsend is stuck on a plane or something? Are they here to comment on changes to the IPS?
Are they here to? No, they'll be here later. They will be here later. They're expected around 11:30.
Okay. Maybe we should wait to hear what they have to say before voting.
Is it fair to say that Steve has opined on this?
Yeah, we've talked this through with the general consultant for the police system.
Just real quick. So essentially, in June 12, 2012, we put in 125 million into this account.
Right.
Essentially. Did we add any other money into it at all since that time? So it's earned 20% since that period. And the language, this is the actual language being proposed to be put into the IPS?
This is the actual language being proposed in IPS, which is substantially the same with the other systems that actually invest in REITs as a policy target.
Mm-hmm.
For us, it's just for police. I'm saying us. Police is just a parking place.
You guys okay with this?
Townsend already opined on it.
Already talked about it. I'm
we
fine
wouldn't
with
bring.
it.
We wouldn't bring something to you guys like this without having the input of our consultants.
Okay,
we don't
sure.
do business that way.
As long as when they come in later, we'll just ask them quickly about it.
I'm sure he's going to say the same thing.
Yeah, I'm
He's
sure
fine
he is
with
too.
it.
But we should still ask. So I'm happy to vote in favor of it. We'll just ask them later.
So I make a motion that we accept the proposed language for the IPS on parking place for real estate assets. But at the same time, I'm sorry. Okay, let's vote on that first.
We have a second?
Second.
All in favor?
Aye.
Okay.
When this is added in, can you send out, again, I always say this, whenever there's a change to the IPS, send out a whole new copy of the IPS, clean version, so everybody will have it. Because these things do get modified, and when they do get modified, we want to know which version we're working off of. So, all right.
That's all we had for the public session.
So make a motion that we leave the public session and go into executive session.
Second.
We'll need 5 minutes to break.